Hello everyone. Let's set the picture quickly because what just happened in the metals market is not something you see during calm, ordinary trading days. This was one of those moments where tension, leverage, and headlines all collided at once. Silver didn't simply slide lower, it was pushed down aggressively. Gold didn't just pull back, it was pressure tested in real time with the entire market watching. And the next several candles are going to decide whether this was a brutal reset that clears excess or the first structural fracture in a trend that's carried traders for months. I'm recording this on Friday, February 6th, 2026 at exactly 4:59 p.m. Pakistan time. And whenever you're watching this, drop a comment telling me what time it is where you are right now. This market is moving so fast that a few hours can feel like an entirely different chapter. Now let's get into it, because today wasn't normal volatility. This was a liquidation event, the kind where the chart stops looking like a staircase and starts looking like an elevator cable snapping. The real question isn't why price fell. The real question is whether the market flushed out weak hands and reset, or whether the structure changed enough that the next bounce turns into a trap. In this video, I'm going to do three things. First, I'll break down what the silver crash actually means, and which levels matter more than emotions right now. Second, we'll look at gold, because gold and silver are related, but they are not identical, and today proved that again. Third, we'll talk about the dollar, because the dollar is the invisible force that decides whether a pullback becomes a launch pad or a rally turns into a rug pull. And don't forget to check the description after the video. I've placed bonus links there, including our premium WhatsApp channel and membership options. If you're serious about staying ahead of the crowd, those links exist for a reason. Let's talk silver. Silver is the wild member of the metals family. When it's calm, it's boring. When it heats up, it's explosive. And when it becomes crowded, it turns dangerous. Today, it reminded everyone of that, loudly. Over the last several sessions, silver went nearly vertical, attracting momentum traders from everywhere. Then pressure hit, and suddenly there wasn't enough real liquidity at the exact levels where leveraged traders needed it most. That's how you get what feels like a gap inside a candle. Not a literal exchange gap, but a psychological one. Bids disappear, and price drops until it finds buyers willing to stand their ground. Reports today described spot silver swinging violently lower before snapping back toward the mid-70s. That detail matters. Even during panic, there is still demand waiting underneath. But demand does not mean the decline is finished. Demand only means price found temporary footing. So what's the real line in the sand for silver right now? It's not a magic number, it's a zone. That psychologically important low 70s area that acted as a base before the last explosive move higher. When price returns to a launch pad, the first test is always painful. The market asks a single question: are buyers still here when it hurts? Here's where most people mess it up. They see a long lower wick on the daily candle and scream bottom. One wick does not equal a reversal. One wick equals a fight. Sellers pushed down, buyers pushed back, and the close landed somewhere in the chaos. The close is the scoreboard, not the low. If you want to read candles like a professional, stop staring at the drama and start watching the result. Now let's add the ingredient most people ignore: mechanical pressure. This week, margin requirements on major gold and silver futures contracts were raised again as volatility surged. That matters. Higher margin is like increasing gravity. A trade that looked manageable yesterday suddenly needs more cash today. When traders don't have that cash, they don't choose to sell. They're forced to sell. That's not opinion, that's math. That's why I'm not fully buying the comforting narrative that nothing fundamentally changed. Fundamentals may not have flipped overnight, but the plumbing of the market did. When leverage becomes more expensive, the most leveraged positions exit first. And silver is usually the most leveraged part of the metals complex. So here's the counterpoint you need to hold at the same time. Yes, silver can rebound hard after a washout, but when markets are in a margin-driven de-risking phase, rebounds can be sharp and still fail. Trap rallies exist because traders use bounces to escape. That's why the next few sessions matter more than the next few minutes. Now let's address something many of you keep noticing. Silver often looks strong during Asian hours and then gets hit when the US session opens. People love turning this into conspiracy theories. The reality is far less dramatic. Silver is thinner, more sensitive to liquidity, and packed with short-term positioning. When major risk desks and systematic funds adjust exposure during the highest liquidity window, the move shows up more clearly. It's not a button, it's flow. Remember, this is a 24-hour market now. Pressure can build in one region and release in another. Reading one session in isolation is how people get hurt. So what should you actually watch next? Two things. First, does silver hold the base zone and begin printing higher closes, not just higher highs? Second, does it reclaim key short-term trend markers like the 50-day moving average? Above those markers, dips are treated as opportunities. Below them, rallies are treated as exits. That single shift flips psychology. If silver continues closing below those levels, digestion isn't over, and digestion is messy. But if silver stabilizes, tightens up, and then reclaims levels with volume, that's what a real reset looks like. Markets stop bleeding first, then they walk, then they run. Quick question for you. Comment one word below: trade, stack, or macro. I read these because they tell me what content actually helps you. Now let's frame the chaos with numbers, because numbers cut through emotion. Today, silver's implied volatility surged near the mid-90s while gold hovered closer to the mid-30s. That spread explains why silver feels like a sports car on black ice. Small inputs, massive outcomes. Silver is a hybrid. It trades like money when fear dominates, but like an industrial input when growth expectations wobble. Gold is cleaner insurance. That's why gold often steadies sooner. Think in layers. The top layer is the paper market: futures, options, leveraged funds. The bottom layer is physical demand and long-term allocation. On liquidation days, the top layer can crush price even if the bottom layer hasn't changed much. Reuters reported margin requirements rising again. When margin rises, the first wave of selling is survival selling, not bearish conviction. Traders sell what they can, not what they want. That's why the tape looks irrational. This is where people blow themselves up by averaging down emotionally. Averaging down is a strategy, not a feeling. If you don't have a plan, you're negotiating with the market, and the market never negotiates. After liquidation days, I watch the second test, not the first bounce. The first bounce is often short covering. The second test is where real demand proves itself. Closes matter. Weekly closes matter even more. Institutions mark risk on weekly cycles. A weak weekly close keeps pressure on. A strong recovery can flip sentiment fast. Zoom out. Markets are designed to make you act at the wrong moment. Fear shrinks your time horizon. Your job is to stick to levels, manage size, and let the next few closes tell the story. Silver is thinner than gold. That means big orders move it more. Stops accelerate moves. That's microstructure, not magic. Historically, after parabolic advances, the first violent correction is rarely the last move. Markets move from mania to fear, from fear to boredom, and if demand remains, back to trend. Now let's pivot to gold, because gold decides whether today was a scare or a signal. Gold was the adult in the room. Not immune, but composed. It held critical territory in the high 4800s while panic spilled elsewhere. That divergence matters. Gold's buyers are different. Central banks, long-term funds, insurance seekers. Technically, gold's line in the sand is defined by its behavior around short-term averages. Holding them suggests defense. Losing them repeatedly suggests deeper reset. Today delivered uncertainty, not collapse. Small-bodied candles tell you buyers and sellers are evenly matched. That kind of indecision sets up powerful moves. Real damage would look like repeated failures to reclaim averages, weak bounces, and dollar strength at the same time. Which brings us to the dollar. The dollar isn't a light switch. It moves in phases. Right now, it's chopping in a lower range compared to prior highs. A soft dollar helps metals, unless forced selling dominates. During margin stress, correlations break. Cash becomes king. The real question isn't, is the dollar up today? Is the dollar transitioning into a trend? Silver's industrial role means it gets hit twice during risk-off events. Gold usually only gets hit once. That's why silver overshoots. Now here's the discipline most people lack. You can be bullish long-term and still respect short-term damage. That's not contradiction. That's survival. Playbook time. Stop trading emotions. Define levels before the market moves. Respect closes. Watch rebound behavior. Healthy rebounds build. Weak ones spike and fade. If silver stabilizes and gold holds, the rebound can be violent. If silver breaks and gold follows, that's repricing, not a dip. Markets give mixed signals on purpose. As for that $6,000 gold target, it's possible, but only if conditions align. Sideways movement is also possible, and sideways is how markets punish everyone. If you're new here, welcome. Metals are not sleepy investments. They're confidence trades. Stackers, your edge is time. Traders, your edge is structure. Margin hikes can increase volatility short term. That's mechanics. Watch the next two closes. Panic, evaluation, commitment. No one gets paid for calling the bottom. You get paid for positioning after confirmation. Final question, reset or fracture? Comment one word. Take care of yourselves, manage risk. And remember, in markets like this, being early can feel exactly like being wrong, until the chart proves otherwise. This content is for educational purposes only, not financial advice. Do your own research.